Hi, this is Mike Maloney, and we've got a brand new video format for you here. So let us know if you like this, and we'll do it a whole lot more often. So this is your gold silver update for Friday, March 6th, 2020, and man, what a week it has been in the markets. It has just been absolutely crazy. And what's happening really is all of this stuff that I've been writing about and talking about, it's finally happening right now. It's here, and it's going to unfold pretty quickly, I believe, over the coming months. Now, I get my news from my own website. This is how I stay informed. I have a friend that we met when we were 13 years old. We've known each other for more than 50 years, and he scours the world for the best articles that he can find on economics, what's happening politically in the precious metal sector and the stock markets. And so what I'm concerned about more than the price of gold and silver is the gold-silver ratio, and it touched 97 today. And I mean, this is amazing. I'll show you why later. But 97, I believe it's probably going to go higher. You're going to see this up. It's going to top 100 sometime soon. But that, to me, just spells opportunity. If you want to take a look at a pretty good article here, this one, once silver starts to rock and roll, here's what its volatility could look like. And this is by Jeff Clark, the senior precious metals analyst at goldsilver.com. But first, 10-year treasuries fell to a new low of 0.7. This is for a 10-year. This is crazy. And what that means is they're going to have to do another rate cut of the Fed funds rate. This half-point cut that they just did is not enough. The markets are expecting a big deflation to happen. That's the reason we're down here under 0.7. And what's happening is investors are running from stocks and from emerging market sectors and from all over the world into the safe haven investment that they've been taught to run to for the past 50 years or more, and that's U.S. Treasury bonds. And a bond is just an IOU from the government. So they're going to borrow your currency for 10 years. They're going to pay you 0.7% per year. And then to pay you back, this is the hilarious part, they tax you in the future. And then they pay you back from the taxes that they charged you. Because all of the principal plus the interest, the yield that you get from treasuries, comes from taxes. So that article that I was talking about that Jeff Clark wrote, once silver starts to rock and roll, here's what the volatility could look like. And he analyzes the volatility back that has happened since 2015. And the average change in gold has been plus minus about 0.58%. So a little over half, six tenths of 1%, where it's been about 1% with silver. So silver always shows greater volatility. When gold and silver rise, silver usually rises further. When they fall, silver usually falls further. But with the gold-silver ratio at the extremes that it is at, it just shows you where the opportunities are. The volatility in prices soared in 1979 through 80. And so here's going back to 1971. And what you see here is that there were 5 days where the volatility, where silver's price gains were greater than 20%. And there was 1 day back in 1979 where silver gained 36.5% in a single day. And these types of, I believe that these types of gains are coming again, and that is the reason I've been doing what I've been doing for the past several years. And I want to give my thanks to High Heat here. This is a tweet. Silver is the cheapest asset in the world. No counterparty risk, no expiration date, no risk of rehypothecation. Now, if you don't know what rehypothecation means, let's say you own something like a gold or a silver ETF, the exchange traded funds, GLD or SLV. Rehypothecation is when somebody sells the same thing more than once. And so say you've got shares that represent an ounce of gold in your GLD or 1,000 ounces of silver in SLV. The broker can go into your account and borrow those shares from your account and loan them to somebody else who's going to sell them to another person. So now two people own that same ounce, you and somebody else that it's been sold to by the person that borrowed them. That borrower is called a short seller, and you can short shares of GLD and SLV because they are not physical gold and silver. They're a derivative of physical gold and silver. And so at any given moment, if there's a short position against that fund, it means that there are more owners of ounces than ounces that exist in that fund. It's just the math of the way short selling works. The way it's called short selling is the person that borrowed it and sold it is now short gold or silver. He sold it, but he never owned it in the first place. So he's got to buy it back, and the shares are supposed to be returned. But you never know what is going to happen in this crazy world we've got. Silver is antibacterial. It is real money. And the thing about real money, watch episode 1 of Hidden Secrets of Money. We do not use money. We use currency, national fiat currencies that are designed to lose value. Money has to be a store of value, and only gold and silver have proven to be money time after time for thousands of years. And it's still selling at less than half the price that it sold at more than 40 years ago. So this is just amazing. So some of the things that are on the radar in the news. Sven Heinrich, if you haven't read him at Northman Trader, he is a great analyst and great writer. You need to start taking a look at some of his stuff. But President calling for negative interest rates in the United States. The Fed should cut and stimulate. Why should Germany have an advantage over us on interest rates? We should have the lowest rates in the world. Well, I think that the president doesn't truly understand economics. There shouldn't be any such thing as negative interest rates. That is just the crazy world of Keynesian economics. There's an op-ed in CNBC written by Steve Leisman, and he is their chief economics reporter at CNBC, and it's why Congress should approve a $1 trillion spending package to boost the economy. Now, we're already running deficits that are greater than $1 trillion, and in the video that I just did a couple of days ago, I said that there would be the deficits that are heading our way are going to be multi-trillion-dollar deficits. And I would not be surprised if we don't actually do this. And all that means, the Fed can't create currency by getting the banks to do it for them. When they lower interest rates, that's what they're doing. They lower interest rates and it gets the banks to create currency by creating loans. The Fed is out of that ammunition. They can't go much lower than they're already at. And even if they do, it isn't going to encourage people to go out and borrow and buy new cars and new homes when they're scared that there's something wrong in the economy, that there's this coronavirus outbreak, that we're in this coronavirus crisis. And so we are in for multi-trillion-dollar, so get ready for 2, 3, 4, $5 trillion deficits. When they're creating currency on that scale, it can only mean higher gold and silver prices one day. Dan Tapiero writes, unfortunately, very clear U.S. economic data will print very bad in coming months. Well, it's not just going to print bad. This isn't just going to be a recession. It's going to be either the worst. I think that this is going to end up being a depression, actually. It's going to be worse than a recession. The Fed should cut to zero. Mortgage rates should be at 2%. I really don't think 2% mortgage rates is going to help. I mean, some people might refinance, but I don't think that you're going to see a bunch of people buying new homes and stuff. Or below will help buffer the economy. Weaker U.S. dollar will pressure other countries to follow suit with the stimulus. And so the entire world will be printing their currencies into oblivion. And he's betting on Trump to corral the troops into the election. And that's probably what will happen. So I want to welcome the 2,100 new subscribers that we had since I put out the video 2 videos ago, about 3 days ago. That video where what I was trying to do for everybody is sort of connect the dots. That was the day that Jerome Powell announced the half-point rate cut for the Fed funds rate. And when he did that, There's a series of things that follow from that, and you can see, so I went on the Federal Reserve's website, generated a whole bunch of charts, and tried to show how these things all connect so that I can try and predict the future. So I want to welcome those 2,100 new subscribers, and if you get anything from our channel, if you get anything from these videos, please subscribe and click that notification bell when you do, and you'll get notified whenever there's a new video. So next up is the chart of the day, and this is from my friends at Incrementum. And they've got the average working hours to buy the S&P 500 going all the way back to 1860 to today. And they just came out with this new chart book, and what it shows is that the stock markets have never, ever been this overvalued, that they are just in this hyper bubble that I have been claiming that they were in for, ever since, it's this entire century. If you go back, we exceeded this rate in like 1995. The stock markets actually were in a hyper bubble, and they've been there the entire century. They came back almost to fair value back in the crash of 2008, but then bounced right up into hyper bubbles. Viewer feedback. I want to skip through this pretty quickly, but I want to thank everybody. This is the video that I was talking about. If you haven't watched it, you might want to go back and take a look at it, because there's some things in there that I think, were sort of new for people. And my thanks to David Brady of Global Pro Trader. I urge everyone to watch this latest video from Mike Maloney. It echoes my long-term view that the Fed will throw everything at this market to keep this Ponzi scheme alive as long as possible, and whatever that means for precious metals going forward. So thank you, David. Luke Shackleton. I'm confused between the threat of deflation in 2008 to real deflation coming soon, which is, I wrote all of this, the roller coaster crash, in my book, and we've made videos on this. What's the difference? Well, it's time to, I really don't have the time in this video to explain it again, because I took almost an hour between these two videos to explain it very, very thoroughly. This was 4 years ago, where I started first describing what the roller coaster crash is. I first described it when my book came out in 2008. But this is what is happening right now. This video of 4 years ago is coming true right now. And then Hidden Secrets of Money episode 7 really describes what velocity of currency is. And this is something that the world's central banks and the Federal Reserve cannot control. They can print currency, they can manipulate interest rates, but they cannot do anything about velocity. That is something completely out of their control. Velocity is something that is controlled solely through human emotion. When people are scared, velocity slows down. And velocity is what determines inflation and deflation over the short term. Over the long term, it's the quantity of currency that determines prices. But over the short term, it's how quickly that currency is changing hands. And when you feel good and you go out to dinner and you spend some money, then velocity picks up. If you get scared and you stop spending currency and you cancel some of those automatic subscriptions and stuff that you've got going on, and you don't do as much shopping, you don't go out as much, you eat at home instead of out at restaurants and so on, then velocity slows and deflation happens. So that's what the difference is. Take a look, especially at this episode 7. But everything that I said in these two episodes is happening right now. In episode 7, you're going to, in your mind, have to introduce Fed Chairman Jerome Powell into some of these animations that have Ben Bernanke and Janet Yellen, because he's Fed Chairman now, and he's the one that's actually dealing with this, and he's the one pushing these buttons and pulling these levers with the economy, trying to control things. Aaron Levi, I'm surprised you still think that silver will return to $14. I didn't rewatch the video, but I don't think I said that I think that it will return to $14. I said that I think that there could be one last pullback that happens with these deflationary events, and that's due to margin call. When the stock markets crash, people have to liquidate whatever they can to cough up the cash for margin call. And so I think that that happened back in 2008 when the markets crashed. So did gold and silver for a while, and they did a significant pullback. And I think you could see the same thing happen. And I said, I hope. I didn't say I think that, but I believe what I said is that maybe I'm wrong. Leave it in the comments. But I hope that silver returns to $14 because I've already got a substantial position. And if it just continues rising, I'm probably not going to add that much to my position. But if it pulls back to 15, 14, I'm going to be backing up the truck. I will borrow to go out on a limb here and buy silver that cheap. So the response to the coronavirus update, where I did a couple of these interviews with Chris Martenson, who I've worked closely with in the past, and Chris is a friend of mine, and I trust all of the things. He's been the most accurate so far on his reporting on the coronavirus pandemic. And so here's Flicked. I'm trying to figure out what the hell people are so scared of. Well, I'm sorry I'm laughing. I shouldn't be laughing over this. If you go to all of the coronavirus update sites and you look at the cases that have had an outcome, I was just doing that today, and then you do some of the math and you calculate what percentage of people die compared to what percentage are cured, that recover, that no longer have the coronavirus, the disease. And right now, it's greater than 6% is what the numbers divide into when you take the total worldwide reporting. 6% of the people die. Now, that's heavily skewed to people that are over 50, especially over 60, 70. I'm in my mid-60s. And then if you've had any type of aggravating condition, I was exposed to mold a couple of times, and I've got some chronic lung issues. And this virus kills you by through pneumonia, and the little, I can't remember what they're called right now, but the little sacs in your lungs that exchange the carbon dioxide for oxygen, they get filled up with mucus, and basically you suffocate. It's not a pretty death. And so what are people so scared of? Well, I'll tell you what. I probably have, if I get this thing, I've probably got a 20% chance of dying from it. That's what I'm scared of. Thoughtfully lost. You're helping people to spread the panic. The only preparation is don't let people cough in your face, which is something I have never done. If you're very old, very young, or already sick, then yes, you should probably take precautions. Everyone else should just chill out and stop listening to idiots like me and Chris Martenson, I guess. Well, you're very welcome to not listen to me. You can unsubscribe from our channel. But I'm not trying to spread panic. I'm trying to spread preparation. And so that brings me to Liz D. And thank you so much. Just had a big argument with my husband about COVID-19. He thinks I'm an alarmist because I keep telling close family and friends to prepare. Our spare room she's stocked with supplies. It's not about panic. It's about being informed and prepared. And that's the thing. I, if anything, am over-prepared. And then on top of that, I'm in a profession. I'm an author, and I'm writing a book right now. It's a very solitary thing. I think that I'm prepared enough to where I could actually maybe not even open my front door for 6 months at this point. And I did it a long time ago before it was a stress on the economy. What's going to happen is the panic is from people that didn't get prepared because they were telling everybody, oh, they're just spreading panic and confusion and everything. Chris Martenson is giving people the most accurate facts about a month or more ahead of the World Health Organization and the CDC. So it's worth checking out some of his videos and getting prepared yourself, because there's going to come a time very soon when everybody else will panic, and you want to be the person that doesn't. Art Garelli, this is a reset of the entire financial system. The Fed will go to a digital currency. I believe that you're probably right. Do you think that central banks will use this as an excuse to go to go digital. Leave a comment below. And I think that you're absolutely right. About a year ago or 2 years ago, Dan, my producer, said that, watch, one day there's going to be some reason that the Federal Reserve and the world's central banks will say that we have to ban cash. And it'll probably be for sanitary reasons that we have to ban cash. Well, the Fed quarantines US dollars that are being repatriated from Asia on coronavirus caution. So they're basically saying, well, viruses can survive on the paper. And so this is unsanitary. That's one of the reasons that they would want to get rid of it. But the other one, when I was talking about they want to go with negative interest rates, if you go too negative, people just take cash out and stick it in a safe out of the bank because it costs you to have currency in your bank account. It costs the bank the funds to have to own short-term bonds and things that are when they get into this negative interest rate realm that is only a realm conceived by Keynesians don't understand real economics, and I've got a book coming out on that sometime soon. You'll see it hopefully later this year. Our mission at goldsilver.com is to enlighten the world that maximum prosperity can only be achieved through free markets, free people, and sound money. And this is a fact. And we don't use money. We use fiat national currencies that are designed to lose value. Watch episode 1 of Hidden Secrets of Money. The quote of the day. This comes from my buddy and freedom fighter, Milton Friedman. But first, make sure that you subscribe to the channel. Take a look at the news on our website and go to our website and let me give you a copy of my book for free. It doesn't cost anything, but you do have to visit the website. You don't have to subscribe, but we would appreciate it. And click that notification bell. Many people want the government to protect the consumer. A much more urgent problem is to protect the consumers from the government. And that is true. Thank you so much, Milton. That's the end of this video. I hope you enjoyed it. If you did, please share it with somebody. And like I said, subscribe and click that notification bell. Thank you very much. We'll see you next time.